This is flashcard number one, looking at chain trading, a specific form of that, beginning with an unambiguous down move. Now, this could have been caused by a hybrid frog or a morning hook, collapsing dragon, big gap down, anything. Some unambiguous move. It's at least 1.5 frog boxes. And then the price no longer is failing, it's stabilizing, and then that gives us the beginnings of the start conditions for a reversion trade called the OWL or an RLCO regression line crossover pattern 1 failure pattern. Those are both directional moves that are chained to that original link. So this first big move down gives us the information that the symbol is in play, that there are traders imbalanced that are moving the price in a strong way in one direction, in this case the direction down. When that move is over, and we see the RLCO outside the river pattern 1, that really is the beginning of the OWL criteria. There are a few more things for the OWL to fire. It's not just a pattern 1. But when that works, the OWL will be a reversion trade, a reversal trade that goes on to glory. But if that pattern 1 fails, in other words, price fails to get to the Bollinger Band mean and then resumes the trade downward, the failure, then we expect the P1F pattern to work, and we think that size of that down move will be the size of the original unambiguous down move. So it's just more of the same. It's the second leg down. But if price has stabilized and gives you neither an OWL nor a P1F, then chances are it's developing into a sideways quiet channel at the new price level, and it is directionless as there's a balance now between buyers and sellers. No strong conviction one way or the other. So let's see how that might unfold. So at the moment of opening, we have an open here, and yesterday it may have closed here, and so we have some measured gap down. If this is a large gap, larger than the gap stat, then we think today has a probability of being a large range day, so we really want to be good on days when the gaps are large. And so it opens here, and we hang, if we're using a hybrid frog strategy, we hang a hybrid frog box off the open, and when it breaches, boom, we're short. And now in this case, it's given us a 1R move. The size of the frog box, or the hybrid frog box, is the size of the move downward. And we have the unambiguous move down. It got to the lowest low during that leg down, the low of the day. And now what we have is FTFF, failure to fail further. And when we see that happen, we can do a quick estimate and say, this is the size of the unambiguous move. And we are now seeing failure to fail further. The next thing we look for the OWL or for a pattern 1 is the regression line crossover outside the river. And so here we have the RL10 crossing the 30. Now if this goes on to become an OWL, a few more things have to happen. But one of the things we'll notice is that the RL30 in successful OWLs gives this long, slow upward curve. And in the successful OWL trades, this RL30 is going to look like an excellent trailing stop in hindsight. And so that's actually one of the things that you can use to evaluate the quality of the upward move is the 30 continuing to roll upwards, and is it acting like a good stop? If it keeps all the price north, then it's looking like a successful type of OWL trade. So back to our OWL. So condition 1 was the unambiguous large move. Condition 2, the RLCO outside the river. Condition 3, the RL10 crosses the dragon. Condition 4, the dragon has started to curl up, and that usually happens within a couple bars of the RL10 having crossed. If it hasn't failed, then chances are there's enough information now to make the dragon start curling up, and then the RL30 should start curling up shortly thereafter. And then we have all the conditions for an OWL, and then a pocket here is formed, and we buy that in the elbow of the dragon, if you will. And then an entry occurs at number 6 after the RL30. That's usually the last thing that happens, and we get our entry, and then off we go. And when this OWL forms and we're in this we're in this trade. If this is a successful owl, what we're going to see is a series of little pockets all the way up where price will go up, it will consolidate and pull back or go sideways. The RL10 will start to roll over. It will find support on the north skin of the dragon. The dragon will act as support, and then it will resume. That's a pocket. That's a re-entry point if you got out. That's a place to consider adding a second position if the numbers work out right. It's not unusual to see 2 or 3 pockets after the initial entry. It's rare to see more than 3 because that's about how far the intraday traders can move things in one trade before they get full and decide to start locking in some gains. So that's a chain where we went from an unambiguous move to a chain of an owl. Now, if the RL10 never even gets through the dragon but starts to roll over and you get a 1, 2, 3 failure, that's enough to get short and call that a P1F, P1 pattern 1 failure. And then the estimate is that the size of that trade, of the next trade down, is the size of this leg. So however big that leg is, the second leg is going to be that big by estimate. The place to get in is if you find the RL10, the belly of that, the swing low of the RL10, not later than that is where we want to be short. You can get short anywhere from the point where the RL10 is rolling over to the point where it makes a new low of the day, and then that becomes your not later than, and the size of that trade is this big box. That's the easiest one to see, one of my favorite patterns. Now, if you neither get the owl nor the P1F, or if you get them in but then they fail back into this chop that began with this failure to fail further, you're now starting to see Crocodile River emerging from that and the sideways quiet channel. Then just wait 15, 20, or 30 minutes, let things settle down, and then start framing additional trades using the Z3P and Z3PC framework. So this is chain trading. I think of it as chain because you have these little modules, these links in the chain, and there are interfaces between them. It begins with the unambiguous move. In this case, I'm showing it as down, but it works on the upside as well. The unambiguous move is what tells you that the traders are imbalanced today, that there's some people that have a lot more belief in money than others, and so they're pushing the trade in a certain direction. That momentum, that power, that distance is what tells you the trade is in play and allows you to start framing additional modular trades and start building the links of this chain that gives you this chain of logic that takes you through the course of the day on your target of interest until you get the sideways quiet channels, in which case you know that the energy and the emotion have left the building. So that's what we mean by chain trading and how we think of the unambiguous move leading to either an owl as a reversal or the P1F failure, which is a continuation of the original fail. Thanks for your attention.